Hi there, it's Walter here, and Ulrich3 has made a really interesting comment in the Naked Forex Now forum, and I just wanted to take a look at what Ulrich3 was looking at and just post a video here so everyone can check it out. So this is, of course, the post in the, let's see here, it's right over here, actually. In the money management forum, what's the big deal? Why money management matters? And here's his post right here. So it's post number 4. So let's take a look at some of the ideas that Ulrich3's brought up because I think they're really important. I think they're interesting. Let's take a look at the indicator. So as you know, I'm definitely not an expert in indicators, but let me show you the ATR here. This is the Kiwi US dollar daily chart. Now, I'm going to draw a line here, and this is somewhat arbitrary, but I'm trying to draw a line at about where I would say the midpoint is, where I would say the average ATR is. And although it's not that critical, it just does give a little bit of perspective here. So I think it's right around 120. You can see the ATR has been as low as 60 down here, or near 60. The market got down near there here in March of 2010. And then it's gone as high as almost 200. It was up here to 198. And that was recently in August of 2011. So it does vary quite a bit. But I would say the average is probably right around 120. And that's because some of these extensions beyond the midpoint here, like look back here, this is back in 2008, it went as high as 278. Now what does the ATR tell us? As Ulrich has sort of shown us in the forum, the ATR is the average true range. Well, what does that mean? For those of you that are not familiar with it, I'll just talk a little bit about it. The ATR is just taking this number of bars. I've set it to 14 bars, right? 14 candlesticks. You can change that if you want. The ATR can be changed to 5, which means it's going to give you the average true range of the last 5 candlesticks. But in this case, I'm looking at ATR 14. I'm not sure, but I think it's the default for MetaTrader, so that's why it came up like that. Now, what is the average true range? So the average true range is basically just taking the range, which is essentially the high, the difference between the high and the low. And so for this candlestick, it would be 190 pips. It's adding that range to that candlestick and that one and that one and that one, and it's dividing it by 14 for the last 14 candlesticks. Now it's actually a little bit more complex than that. The average true range does take into account gaps. So for example, this right here, instead of saying that the range of this candlestick is from this low here to this high, and in that case it would be about 130 pips, it actually takes into account the close of the previous candle in the case of a gap. So in this case, this candle would actually include all of these pips in the gap, and it would be about 199 pips. So it's not exactly the range of the candlestick, but rather sort of the move from the close of the previous candlestick in the case of a gap. But usually it is going to be the range. It's only when there's a gap that it'll calculate it slightly different. But that's not that important. The important thing is it does exactly what Ulrich3 is talking about. The ATR will give you a good idea of how great the average movement has been in the market recently, right? So you can see here, if I look at my chart, I go to the present day here, the ATR 14 is saying 0.0136. That's saying the average move on the daily Kiwi is 136 pips, which is a little bit higher than my average I've drawn in here at 120. I don't know if the average is 120. I'm just guessing, but you know, like I said, I think it's probably right around there. Given when I back it up and just it passes the eyeball test, right? Some of them are lower here, but some of them are higher. Maybe it's a little bit higher, maybe it's a little bit lower, but it's probably going to be somewhere around there. Given that this maybe it is a little bit lower. I don't know. Also, it's going to depend on where the market is, because as currencies tend to increase in value. In other words, you know, the movements are cheaper, aren't they? When the pound yen is at 220, a move in the pound yen is a little bit less than a move in the pound yen when the pound yen's at 130. So you have to keep that in mind too. And you can see that reflected here on our currency pair here, which is the Kiwi. If we go all the way back to 2001, when the Kiwi was down at 39 cents down here, you can see the average true range was really between 27 pips a day and 88 pips a day. In that case, the average true range probably would have been, whoops, I drew the line in the wrong spot. Probably would have been somewhere around here, around 50 pips or something like that. So it's important to keep in mind perspective too. I'm talking about right now. Anyway, that's not that important. So let's take a look at what Alaric was talking about in terms of using the ATR for risk. The calculations that Alaric talks about are for the purpose of this, I just want to look at this like broad picture, right? You can go back to the post and see exactly what he's talking about. But essentially what Alaric is saying is that when the market has a high ATR, you better be careful, right? Take smaller trades, because when the market has a high ATR, it suggests that it's moving quite a bit. Each candlestick is likely to be a pretty big one on average, and when the ATR is quite low, each candlestick is likely to be a pretty small one. Now, that's, in essence, that's correct. However, I would say I would be a little bit cautious, and here's why. If I were looking at, say, this trade right here, as an example, this is essentially, if we zoom in here, this is essentially a sort of a trendy kangaroo tail. The market's been sort of choppy, maybe moving up a little bit. Maybe you don't call it a trendy kangaroo tail, you just call it a kangaroo tail, and you say, look, I've had a pretty good zone here. Let me just change it to my preferred dash line. So you say, look, I've seen some touches here, so a touch there, there's a kangaroo tail there, there's a bounce there. It looks like there's a zone somewhere around this area here, and I've got a kangaroo tail. So you say, I want to take this kangaroo tail right here, okay, marked with the arrow. Now, if I go down here and I take a look, it looks like my ATR is actually around, when this kangaroo tail prints, my ATR is around 70, 60, 71 or so, maybe a little bit lower, maybe right around 70. So that's pretty low in terms of the ATR, where I have my average at 120, right? And that makes sense because the market's been sort of having a few small bars, a few big bars here and there, but it hasn't really been in a really strong extended move like we saw back here, right? So maybe it's not a trendy kangaroo tail, maybe it's just sort of a choppy market and it's printed kangaroo tail. But the important thing here is that according to this theory, we're saying the ATR is saying, hey, it's okay right now if you want to really pile on the positions. Your position can be bigger here, whether it's your initial position or your pancakes or whatever. Right now is a good time for risk. Why? Because the market hasn't quite really broken out yet. It's kind of, overall the ATR is telling us that the moves haven't been really that big. Okay? So let's hit, you can see our trade is triggered here on the next candle. I'm going to hit the F12 key and see what happens. You can see what happens is the market actually goes up. It takes out the recent highs up here. Boom, right there. And then it comes back down, and perhaps it stops out at break even, or perhaps I'm holding onto the trade more, and it keeps going. In fact, it's gone all the way up to these bar lows over here as well, or just near there. Come really close. And then guess what happens? We get this wild bar right here, and the ATR starts to creep back up. Creep back up. Remember, it was 70 down here. Now all the way over here, it's as high as 100, right? So it's gone up quite a bit. So in this case, we would have had a rather large position on, right? But the market was more or less choppy. It did go to my initial target up here, which would have been these bar highs here. And that would have been fine. But then it chopped around a bit. And maybe if I move my stop to break even, when I reach here, I get stopped out at break even, waiting for a bigger move, and then the market takes off. Interesting, right? Now let's look at another example.